You find yourself watching the market, knowing exactly where it's likely to go, but always miss out because you don't know how and when to enter. You understand market movement, you see the trade setups, but when it comes to pulling the trigger, hesitation kicks in. Before you know it, the market moves without you. Does it sound familiar? If so, then you're in the right place. In this video, I'll show you how to overcome this problem. But first, you must understand two things. One, you don't need to capture the entire move to be profitable. Timing the exact start of a price move isn't necessary. You can still enter after the move has started and still make profit. Secondly, successful trading isn't about having just one entry pattern. Relying on a single setup will limit your opportunities. The key is having multiple simple rule-based entry models that will allow you to take advantage of the many opportunities the market gives you. That's exactly what I'm here to give you. In this video, I'll walk you through 5 simple rule-based trade confirmatory entry models designed to help you confidently enter the market and capture high probability, stress-free trades using the fair value gap concept. We'll start by diving into fair value gaps, explaining what they are and why they are crucial for identifying great trade setups. If you are already familiar with fair value gaps, feel free to skip ahead to the entry models. A quick note. This video is intended for traders who already have a good understanding of market movement and can generate trade ideas by themselves. If you are brand new to trading without this ability, this video is not for you. Not yet. I'm Josh, a Forex trader and mentor with over 3 years of experience, and I'm just the mentor you need. All right, let's dive in. The fair value gaps. The institutional order flow pattern is based on a 3-candle pattern. Now you can see 3 candles here. We have 1, 2, 3. It is a clear indicator of price displacement. So the fair value gap is formed by 3 candles. We have the first, the second, and the third. Now, once the second candle trades through the low of the first candle, now we are dealing with the bearish ICT fair value gap. Once the second candle closed below the low of the first candle, we don't want to see the third candle that will be opened to reach for the low of the first candle. We want to see trade away, leaving this gap, meaning that price only traded to the sell side, no trade to the upside, creating a range, which we call market inefficiency. So all I'm saying is this: once the first candle is printed, the next candle should close below the low of the first candle, this candle here. And then the third candle that will be printed shouldn't reach up to the low of the first candle. We want to see it go lower, creating this range in price, this gap here. And this is what we call the bearish ICT fair value gap. The fair value gap is a clear indicator of price displacement. Displacement in price reveals the most likely direction in market movement. So one of the ways we know that there's displacement is when we see a fair value gap. Let's assume market is moving, and then we see something like this. For this to be created, we'll expect that fair value gaps were formed because of the quick movement of price. Now, going back to this diagram here, we would see that price was only traded to the downside at this point. Let me clean this, all this. We can see that every other range is balanced except this point here, and as well this point here. But we are dealing with the bearish ICT fair value gap. So let's focus on the right side of this diagram. So we can see that price only traded here. With this occurring in price, there is a likelihood that price will return back to fill in this gap that was created, which we term the fair value gap, before continuing downwards. I'll use the same analogy ICT uses. Just like you are painting your house. Now, you begin painting. Remember that as you paint and go higher, the areas you've painted before will not be perfect. So what happens? You go back down to complete areas that are not painted. Same it is with the charts. So as price rallies downwards, you see that there is a quick movement of price from the high to the low, leaving a gap. Now, price will seek to run to that fair value gap, that inefficiency, to close it up before continuing downwards. Because why? Sell orders were only offered here, buy orders weren't offered here. Market seems to balance that out to provide another opportunity for buying, because only selling occurred here. So there is need for buying to close this gap. And that's the whole concept behind the fair value gap. The optimal formation of the bearish ICT fair value gap will be found after a run on buy-side liquidity. And the best time you want to see the fair value gap is when market has run liquidity, the buy-side liquidity. Like I mentioned before, displacement tells you the direction market is likely to go. And one way to know that there's displacement is the creation of a fair value gap. So once you see price take out buy-side liquidity with the creation of a fair value gap, which is proof of displacement, we would expect that price is likely to return to close this gap to continue lower. So it is optimal to find this after buy-side liquidity has been taken. It creates an opportunity for a sell. I told you that two places price move to: liquidity above and below the market and fair value gaps. And as well, the reverse is the same for the bullish ICT fair value gap. The institutional order flow pattern is based on the three-candle formation. It is a clear indicator of price displacement. The optimal formation of the bullish ICT fair value gap will be found after a run on sell-side liquidity. So the best time you will want to see this fair value gap is when liquidity, the sell-side liquidity has been formed, and the creation of a bullish ICT fair value gap, which is proof of price displacement, saying that price wants to go higher. Likely, there is a high probability that price will want to return back to close up this gap to provide selling, because only buy orders were offered here. So market want to provide the opportunity for sell orders to be offered here before running upwards. So when you see this, it gives you an opportunity to enter the market for a buy. Here's an example of a fair value gap. So we see the three candle pattern here. 1, 2, 3. It has to be 3 candles. It's not more or less. It has to be 3. I want to see the last candle not reach the first candle. I want to see this gap, and then the second candle trading in between it, leaving a gap. You see this pass through. Now you can notice here, price traded upwards and then traded downwards. So this point here is balanced. Price traded down and then traded up here. This part here is balanced. But you can see here, only sell orders was traded here. So market will want to give the opportunity for buy orders to be traded here. So you would see price rally up into this fair value gap to try to close this range before continuing down. So this is an area of inefficiency, and it provides an opportunity for you as a trader to go into the market to trade, in this case, sell in direction of displacement. So I explained before that fair value gap is a proof of displacement, and displacement gives a likely direction of price movement. So if you see displacement higher, it increases the probability that price will rally higher. And then if you see displacement lower, it increases the probability that price wants to rally lower. As simple as that. Okay. Another very important concept about the fair value gap I have to explain to us before we move further is the inversion fair value gap. What is the inversion fair value gap? A bullish or bearish fair value gap can become an inversion fair value gap by switching roles, just like the name inversion implies. It is the bullish fair value gap previously supporting price turns resistance for price when price returns to it after breaking through it, or the bearish fair value gap previously resisting price turns support for price when price returns to it after breaking through it. Now, you can see here that here is a bullish ICT fair value gap. And then you can see our price returned back to it, found support, and then rallied. Now, this is a bullish ICT fair value gap. Now, once price breaks through it, it becomes an inversion fair value gap. You can see how price rallied up and then found resistance before going downwards. So now this here was a bullish ICT fair value gap. It became a bearish ICT fair value gap. This is what we termed inversion fair value gap. It is support turn resistance. So it was serving as a support here. Once price breaks through it, it becomes a resistance for price. And this is very common in price action. So let's take a look at an example quickly. All right, you can see this fair value gap here serving as support for price. Price came down before rally. You can see the moment price broke through it, as price returns to it, it became resistance for price. So this is the current price action for dollar index. So I'm expecting this fair value gap to serve as a resistance for price to rally downwards. You can remember in a group chat, I explained that price will rally upwards. So I was expecting that this high will be ticking, because you can see how price is reacting from this bullish order block after taking sell side. Let me draw it out. You see, sell side liquidator was taking here. So I expected that once sell side liquidity is taking, buy side liquidity. This is where price was current. That was on a Thursday. So I was expecting this candle to rally up to take this buy side liquidity and then find resistance in this fair value gap. So let me clean all this out. But today we're seeing that price is finding resistance in this inversion fair value gap. So I expect that these lows will be taken in the subsequent week to come. Now we can also see another example here, starting from the top. You can see how price created a fair value gap, a bullish ICT fair value gap. Price came down to fill it up, served as a support before rallying. Now, the moment price broke through it, you can see how price closed below it here. As price returned to it, it served as a resistance for price. So it is an inversion fair value gap. The same thing happening here. You can see this fair value gap. Price found support, then rallied. When price broke through it, you see how this candle closed below it. As soon as price returned to it, it served as resistance for price. So this is what we call the inversion fair value gap. So on a fair value gap, once broken through, you can see another example here. Let me just draw it out. You can see how price came to fill this fair value gap. The moment price broke through it, it becomes an inversion fair value gap. So once price breaks through a respected fair value gap, we anticipate that once price returns to it, it does the reverse of what it did. So here it was serving as a support. Here it became a resistance. And there are multiple examples here. So we can see another example here again. You can see how price served as resistance here. This fair value gap, price went to close it up. The moment price broke through it, as soon as price returned to it, it became support for price. So it is resistance turns support, or support turns resistance. So I hope we get that clear. Now, implementing the fair value gaps. How I use the ICT fair value gap? I use them for entries and for targets. And I'm going to be giving you 5 entry patterns using the fair value gap. The first, we have the market shift plus the fair value gap. The second, we have the break of structure with a fair value gap. Then the third, we have the inversion fair value gap. The fourth, the break of structure plus inversion fair value gap. And then the last, but not the least, the institutional order flow fair value gap. So these are just entry patterns I'm going to give you. These are not strategies. They're just how you can enter the market. So mind you, before you use these patterns, you have to get your bias. Where is market going? You have to start from the higher time frame. So this is what you use in the smaller time frame after you've determined your bias. So you can apply this with the breaker block strategy that I gave to you. So let's move on. So the first, which is the market shift plus fair value gap. Now we all know what the market shift is. Once there's run on liquidity and the break of structure at the opposite side, the market has shifted from bullish to bearish. So you want to be pairing this with the fair value gap. And what do you have? We have the first entry pattern. So let's take a look at it. How does it look? Now, like I explained before, you want to see a run on liquidity or market reacting from a higher time frame order block, bullish block, or a fair value gap. Now, once you've seen that, you've determined your bias, that price wants to run in a certain direction, you go down to a lower time frame. So this is a 1 minute time frame. You can see, let me enlarge. You can see price taking liquidity to the downside, breaking structure to the upside. So this fair value gap here serves as an entry for you into market. So this arrow here is just indicating the trade I took. I actually use this strategy myself. Let me go back. So I entered here and then entered here as price came to the fair value gap. So this is very easy to see. So let's take a look at the rules. Now, there are three things involved: the condition, the entry, and then the stop. What are the conditions? The first thing you have to take notice, this pattern has to be happening in this particular Q zone. Time and price theory is very important. That's what makes price move. You have to understand that it's not just the price, it's the time, the particular time of the day. So you're going to be using either the New York Q zone, the Asian Q zone, or the London Q zone. And you want to use the Asian Q zone with pairs that are in the Asian countries like the yen, Aussie, and New Zealand. All right. So the first thing, like I said, is the Q zone. So you can see that this is happening where? In the New York Q zone. And the second condition you have to see, you want to see a micro run on liquidity. Now, this whole thing, this whole price action here, you want to see it either hitting another block or running buy side liquidity by the left. But then again, when you go down to a lower time frame, you want to see a micro run on liquidity. You can see here, you can see how market took out this buy side liquidity here. And then the third condition, you want to see a break of market structure, a clear break. You can see how market broke. You're not confused, did the market break structure or not? No, you can see how clear it is. Market broke structure. How can you classify structure when you see this three candle pattern? You can see the candle in between is lower than the one by the left and the right. So this is a swing. So market broke this high, took out buy side liquidity, rallied, came down, and then broke structure to the downside. Then the fourth, which is very, very important, is displacement. And I told you that displacement is evident by fair value gaps. So the manner at which price break structure is very important. You want to see this. You see how price broke down with speed and created a range for you to enter. You don't want to be seeing something like this. You see how there is no fair value gap here. You don't want to see this break. You see this actually broke structure here to the upside, but there is no fair value gap. There's no displacement. So you want to see it should be clear. So these are rules. One thing that we should understand is that when you are trading the market with a strategy, you want clear rules that you can follow. You don't want to be thinking in the market. You want to do all the thinking outside the market because you increase your chance of profitability when you know what you're looking for. Because if you go into the chart and then you don't know what you're looking for, you're confused. Is this what I'm looking for? Is this what I think it is? You begin to dabble and then there is no confidence. And when you're not confident about your trade, what happens? You begin to make wrong decisions. But when you look at the chart, you know that, okay, this is what I'm looking for. Is it that I'm entering or I'm not entering? As simple as that. So what are the rules for entry? You want to be entering if you are bullish at the low of the closest fair value gap. Let's go back to the previous slide. Let me show you something. Now you want to be entering with the closest fair value gap. You can see that there's a fair value gap here. Now price could as well come to this point here before rallying, but you want to enter with the closest. You don't want to put your buy limit here because you might lose this trade. You might miss out in this trade. You can see how price didn't get to this point. So you want to be entering with the closest fair value gap. So it created two. You have 1, 2. So this is the closest fair value gap to where price is. So you want to be entering at the high if you are buying. If you are selling, you want to enter at the low of the fair value gap. So let me show you what I mean here. So you are selling here. So this is where you want to be entering at this point here. Where do you want to put your stop? You want to put your stop at the most recent swing low. Here or here. This is the most recent swing low. So you can put it here. Why is it a swing? Sorry, this is the most recent swing high. Why is it a swing high? Because it has two candles at left and right lower than the middle candle. It's very, very easy to see. So we have rule 1, 2, 3, and 4. You can't miss this. Mind you, you don't just go into the chart looking for this. You have to have a higher time frame bias. Now, you can be someone that trade off from breaker blocks. You can be someone that trade off from other blocks. And these are not PDRs in lower time frame. These are PDRs in higher time frame, like daily order blocks, 4-hour order blocks. And then you can combine other things like market open. If you want to buy for the day, you want to see this below the market open. You want to see a protraction against the intended move. And then you can also combine SMT divergence. When you see SMT divergence in your chart, Or you can be a trader who is expecting a reversal. When you see there's a liquidity sweep above the market, you want to go down to a lower time frame to look for this pattern. So when there's a break of structure, as is happening here, as price returns back to the fair value gap, you sell. When, at what time? Either the New York Q-zone or Asian session. It's very easy. Then the second is the break of structure plus fair value gap. So this is similar to the first, but we're going to see a little difference here. You can see that there is no micro run on liquidity. So let's just look at the charts quickly. Good. So there's a break of structure here and then return to fair value gap. So when you see a break of structure, you see that this high did not break this. There's no micro liquidity run. We're going to see that in the rule. There's no micro liquidity run here. It only broke structure. So now the manner at which it breaks structure is very important. You want to see displacement, you want to see momentum, you see the speed, you see how it created fair value gap, breaking market structure to the downside. And it has actually taken buy side liquidity. Let me expand it. It just took it very little. So you can see that it actually went above the buy side liquidity. So it has taken liquidity already. And then you can see how market broke structure to the downside. So, and then you returned when? You don't want to be entering here because, well, it's still London. But look at how it returned New York. And then it rallied downwards. So now, because you're not seeing a micro run on liquidity, what you want to be adding is SMT divergence. So let me reduce this. So you can see that this is the dollar index and then this is the Euro USD. So you can see how the Euro USD was making a lower low and then dollar index failed to make a higher high because these are correlated assets. If dollar index is making a higher high, Euro USD should make a lower low. They are inversely correlated rather. So if Euro is making a lower low, dollar should make a higher high. But we are seeing that there's a divergence here, meaning that smart money is in place. So you want to combine this with a break of market structure and entry at the fair value gap. So let's take a look at the rules. So like I said, our rules are divided into condition, entry, stops. So what are the conditions? We're going to be entering at a particular Q zone. You can see in the previous example, we're entering at New York Q zone here. So I try to give different examples so that we will see how it will look like in the charts. So now the second is the break of market structure, which is very easy to identify. You can see there's a break of structure. At this point here, you want to check the correlated pair. So this is the Euro USD. So in a correlated asset of this pair, we will be likely seeing a run on liquidity, micro run on liquidity, something like this before a break of structure. So just because you don't see a micro run on liquidity doesn't mean you can't enter after seeing a break of structure. You want to check the correlated assets to see if there is a smart money divergence. If there's smart money divergence, check. You can enter the trade. But one thing you know is that point one is actually more powerful than this without this SMT divergence. But if SMT divergence is included, it becomes powerful as entry pattern one. I just hope we get this. All right, so you can see there's a break of structure. Then the third condition is price displacement evidenced by fair value gap. So we can see displacement here. There are two fair value gaps here. Which one would you want to be entering with? You want to be entering with the closest fair value gap. This one here. Because if you put your buy limit here, you might miss this trade. Definitely you will miss this trade if you put your buy limit here. You can see price did not get to this point. And then where do you want to put your stop? At the nearest or recent swing low. So the reverse will be the same for a sell. I just hope we get it. Then entry pattern 3, which is the inversion fair value gap. Okay. So now what we want to see is price rally away. We can say that this swing does not have highs. Okay, if you go down to a 1 minute time frame, you might not see swing highs here. You can just see just one candle going down. So how can you enter the market when the market is about to change? Because this may just be a quick move to take liquidity below the market. And it may just be one candle taking liquidity below the market in the 1 minute time frame, or 3 minutes, or even 5 minutes. And the market wants to start going higher. How can you use a good entry pattern to enter the market? One common mistake we make is that we tend to give entry patterns the relevance it doesn't deserve. What you should give relevance is the higher time frame bias. It's order flow. Where is market going? You don't need to get a perfect entry. Just get a few things that you can determine where your entry is and where your stop is. And you know that if you enter at a particular point, your stop will not be taken out. And then you want to be entering at a point where market is telling you that it wants to turn to the other side. I don't know if you understand. So these entry patterns are actually very unique because they tend to serve as minor confirmations. They are not actually confirmations, but they are minor confirmations, giving you the hint that market is about to turn. So I hope we just get it. So your entries don't need to be perfect. You just need an entry pattern telling you the best place to enter for your stop placement, because you can't just enter anywhere. If you enter at a particular point, you need to place your stops, and your stop has to be in accordance to your risk. If you're risking 1%, it will affect the amount of lot size you are going to be using. So you want to be entering at a particular point where you will have a good stop placement for you to maximize that trade. Secondly, you want to be using entry pattern that tells you when the market is about to change direction. So these entry patterns I'm giving you, these are patterns I use myself and they worked for me beautifully well. They are actually something that if you should know your higher time frame bias. Okay. So let's continue. So now how do we use the inversion fair value gap? Like I said before, you want to see market running liquidity and not just anyhow liquidity. You want to see either previous daily high or low, session lows and high. They are very important. Monthly highs, weekly highs and lows. These are significant liquidity points. So we can see market as around this sell side liquidity. Now, there are two particular ways we can use the inversion fair value gap. This is the first. Now we can see that this here is a fair value gap and price ran through this low quickly. Now, the moment price changed direction, you can see how it's reacting at this fair value gap and then broke through it, just like I explained in our previous slide. You can see how this was serving as a bearish ICT fair value gap. We are seeing that as soon as price broke through it, it became a bullish fair value gap. So when you see this happening, you can be confident to enter here because the likelihood of price running to take this low and take this low is very, very low. So we see we are having two strong conferences here. We can see that this fair value gap here, price respecting it at one point in time. But as soon as price broke through it, it found support. Secondly, we are seeing a break of structure. So these are conferences that increases the probability of price rallying higher. So this is the first. Now let's go to the second. This is the same chart, but a smaller time frame. Now we can see this fair value gap here. Now, you will notice that price broke through it, found support, then rallied. In the previous example, we are not seeing a breakthrough of this fair value gap. We are seeing this fair value gap. We are seeing price respecting this fair value gap and then breaking through it, finding support, then rallying. But here, you can see price broke through it once before coming down. Now, why I'm saying all this is because this is all in hindsight. Because if you are seeing this printing, you will think that price is only going up or retracing, correcting to go lower. You'll be scared of buying as you see price going higher. You don't want to be buying. You can see this huge range and then thinking of buying when price is rallying. As you begin to see price rally like this, you'll be scared to buy because you'll be thinking that this is just a correction. Now, you can see that there's a fair value gap here. You can see how price broke through it. Now, once price breaks through it, you can wait for price to bounce on it. When I mean bounce, I mean use it as a support. So when it's rallying, you can put a buy stop above this high because this break of structure is very, very significant. When you see market breaking structure to the upside, it's telling you that price wants to go higher. So when you see a break of structure above the market, you can enter with your stop here or even here if you are not okay with putting your stop here. But here is very fine with a break of structure. Or if you are very confident with your analysis from your higher time frame and you see price running liquidity below the market. Once you see there's a breakthrough of this fair value gap, you will be entering as soon as price returns back to the fair value gap here before taking your trade. Now, what makes this different from the other one? Let's go back to the other one. What is the first? When you see price reacting to a fair value gap, you see that it's respecting it. Once it breaks through it, you can be confident that it will be able to hold price once price returns back to it. But this other one, we are seeing that price, this lower one here, price just broke through it once before returning. But here, we are seeing that price respected it. Now, we're talking about the yellow one here, this yellow shaded portion. You see price respecting it and then breaking through it. And we're also seeing a break of structure to the upside. So once price is returning back, we can be very, very confident. Now we can see this in price action. This here is safer to enter here. But here, you can see that there is no break of structure. Price is only just returned, except these highs. Now, I'm only assuming that this is just a single down close candle because there are times we'll see that there will be no break of structure as price is rallying or breaking through a fair value gap. You definitely may not see a break of structure, but you just see price breaking the fair value gap. And as soon as it returns, you can be buying if you trust that price will rally upwards. But if you are not confident enough, you can wait for price to break structure to the upside, which is what we now call the inversion fair value gap plus the break of structure. I listed it there in the previous slide, which was the fourth entry pattern. So I'm teaching it together with the inversion fair value gap. So whichever suits you better. Now let's go to the rules. Okay, conditions, entry, stop. So what are the conditions? Again, your Q zones. You want to be entering at a particular Q zone. Then the second, so you want to see price displacement evidenced by fair value gap on the left side. So you want to be seeing displacement on this other side here. You want to see a clear, you don't want to enter when you're seeing something like this. You need that fair value gap to be reversed into an inversion fair value gap. So we can see the same thing happening here. You see how price respected the fair value gap. Price rallied, came down, rallied, came down, rallied, and then stalled before breaking through it. Now, once it breaks through it, you wait for price to return before rallying, or you could wait for this break of structure here because you are seeing price reacting from an inversion fair value gap. So you wait for market to break structure to the upside. So you just set a buy limit here, sorry, a buy stop here, and then your stop below this low here. The third thing you want to see price run through the inversion fair value gap. You want to see price break through. You don't want to see price like this. You want to see a break. Let's go back to that one. You want to see, let me show you something. Let's go to the first. Notice how price closed above it. You see this strong break. You want to see something like this. It should be clear enough that price has broken above the fair value gap. And the reverse is the same for a bearish setup. That being said, where would you want to be entering with this entry pattern? You want to be entering at the high of the inversion fair value gap for a buy and then reverse for a sell with your stop at the most recent swing low. Then the last is the institutional order flow plus fair value gap. All right. So what we want to see is we want to see either of the entry patterns listed above, and then we want to now see price respecting fair value gaps as it rallies in that direction. We can be entering in either of the fair value gaps that we see. So once price rallies, because we can either see a break of structure on fair value gap or a market shift on fair value gap, or we can see an inversion fair value gap created and price reacting away from it. So once price reacts and we see a fair value gap being created, we can enter, or we can enter on a third opportunity. So once you see price reacting from fair value gap, it's saying that order flow is bullish. This here sets the tone for an institutional order flow. All right, so here's an example. You can see there's a market shift here, and then plus the fair value gap. So this is where initially you'll be entering. So if you miss this trade, you can enter on the next fair value gap that has been formed. So you can be entering here. Let me show you. This is also a trade I took. If you notice, this arrow here is different from this arrow. This is more thinner than this. Here is a tool from TradingView. But if you take a trade with TradingView, it records your history with this kind of arrows. If it is a buy, you see it blue in color. I don't know. Okay, here you can see it here. So you can see that this 1, 2, 3 are different from this kind. This kind of looks thicker. So these I actually placed it myself while making the slide. But these here are actual trades I took. So you can see I use these entry patterns myself. So this here is market shifts, which is the first and actually the most powerful. You want to be seeing run on liquidity, micro on liquidity, break of structure, creation of fair value gap. See the momentum here, the displacement. So price is likely to return to give an opportunity for itself. But if you miss this, don't worry. You don't need to catch the top or the bottom. Don't be too greedy to catch the top or bottom. No, just because you missed a trade from the top or you missed a trade from the bottom doesn't mean that you've missed the trade entirely. You can always enter. Look at how the market ran. And mind you, because of space, I had to cut this. Market still continue running downwards. So just because you missed this, you can enter here. And why is entry pattern very important? So that you know where to put your stop. You can't just enter anyhow. You want to be entering with the fair value gap that has been created. If you miss this, you can also enter here again. You can see fair value gap here. Now you can see that no fair value gap was created. Let me just zoom out. I think this was really two opportunities. Now, even if there was an opportunity here, I wouldn't say you should enter because as price continues to go lower, the probability of you making money from that trade reduces because there's a high chance that market would likely retrace and take you out. So the best place to actually enter using this entry pattern is close to where the market move originated from. So these two places is very, very okay. You can enter here with your stop above, enter here with your stop above the most recent swing high. So let's take a look at the rules. So we have the conditions, the entry, and the stop. Again, time and price theory. You want to be entering at a particular Q zone. So I used another example here again so that we'll see multiple examples. I didn't use the previous one. If you noticed, well, when I'm talking about the rules and when I'm giving you examples, I use two different examples so that it becomes easier for us. But what will actually do the work is you go into the chart. You have to go to the chart and look for this thing yourself. You have to back test it, practice them yourself, forward test them with demo trades, and see the ones you resonate with. Don't be too quick to watch the next video. Now, one of the things that you need to understand is how can you practice what you learn? Because it's in practicing that you would actually gain the skills that you seek in this industry. When you receive a video on fair value gaps, go to your charts, look for fair value gaps for like a week. Don't just watch the videos, then maybe go to the charts and then look for it and then close your charts and then wait for the next video. No, you want to practice that particular thing you learned. Don't go to the chart looking for fair value gap, other blocks, break out all of them at once. No, you can get overwhelmed. You can say, okay, you want to look for fair value gaps and other blocks. That's fine. Spend the next 2 to 3 weeks looking for that, practicing it, engaging with it, using it, seeing how it forms, see how you can take trades with it, see how you can also formulate your own strategy with these things. I hope we understand. So you can see how price reacted here. At this point, there was a break of structure, but it's not that significant. But here you can see how market broke structure after finding resistance in this bearish order block. So here would have been a good place for entry. But if you miss this, you can see how it created another fair value gap here. As soon as price returns, you can be selling. If you miss this, you can still enter here again. You want to be entering the closest fair value gap. So instead of entering here, you'll be putting your order here because you might not get, price might not get up to this high. Yes. All right. So the second rule is end of the market entry models already in place. So you can either see a break of structure and fair value gap already happening here, or a market shift or an inversion fair value gap entry pattern already occurring here. You're seeing market moving. Once you start seeing market respecting institutional levels, you can see there's a bearish order block, fair value gap, fair value, you see price respecting this institutional levels. It's saying that institutional order flow is bearish. So you want to go with the flow, institutional order flow. You want to go with the flow. And the last is what I just explained, price clearly respecting institutional level. So where can you be entering? Like I said before, at the lows. If you are selling, you want to enter at the lows of the fair value gap, and then you stop at the most recent swing high. So if you enter here, you want to put your stop here. If you enter here, you want to put your stop, so look at the distance. So it is very good to start at the origin. So if you don't get it, you can still enter the market. Don't be too discouraged when you miss a move. Try and look for places you can still enter. It is very, very important that we utilize these entry patterns in our trades combined with a higher time frame bias. So I'm going to be combining all these entry patterns. How do we use it? Now you can see that this high and this low are both previous daily highs and lows. From the higher time frame, we understand that price takes buy side and sell side liquidity. The price runs to buy and sell side liquidity. It's not like once buy side is taken, immediately sell side will be taken. Not necessarily so. What usually happens is that price moves from external to internal liquidity. Price moves with context. You don't just expect that, okay, let me just draw something. So this is buy side, and then this is sell side. So once buy side is taken, then you're not expecting sell side to take in. Not necessarily so. That's not what happens. What usually is the case is that once buy side is taken, expect that liquidity at the opposing side will be taken. Now, if this was a trend and you see that price has taken buy side liquidity, expect that price will return back to the internal range liquidity, which is this fair value gap. Although that's not what's happening, I'm just using an example. So close it before rallying to take this buy side liquidity. Now, if you go down to, let's say we could go down to a lower time frame and the price was actually going into this fair value gap to rally upwards, you might see lows being formed, which would be the sell side liquidity. So it would seem to be like price going from buy to sell side. So I hope you understand. Good. So now from the higher time frame bias, we expect that if price runs this high, market will reverse to take this relatively equal lows. So that's what we're expecting. And you can see our market ran this high and then came back down to run this low before rallying. So with what I've taught, there are a few things you can expect from the higher time frame. You can expect that the higher time frame is reacting from another block, breaker block, fair value gap, or taking liquidity. You can also add mitigation block. I have not taught mitigation block. Mitigation block is very close to breaker block. I'll just explain it here. And we know that the breaker block is when price runs buy side liquidity. This is for the bearish breaker block. Once price runs buy side liquidity and then breaks structure to the downside, once it returns higher, I expect it to go lower. Now, for the mitigation block, price does not run liquidity. It will be something like, let me just clean this. This is what we'll see. Something like this. Here is the mitigation block. So this high did not run this high. So that's just difference. So you can utilize this in the chart. So let me see, there's an example here of mitigation block. All right, so we can see an example here. Here's a mitigation block. You can see that this low did not run this low. So you can see our price found support before rallying upwards. All right, back to our trade. So we're expecting price to reverse here. We're expecting liquidity to be taken before market rally downwards, and the same here. All we do is now we'll go down to a lower time frame so we can see a market shift, a break of structure. Once market returns back to this fair value gap, we sell. So this is just the previous example I showed in the previous slide. And the same thing is happening here again. We can see a break of structure. There's no micro liquidity run except this small low here, but it's not that much significant, and would have expected that this high should be broken. But we are seeing this high being broken here. So this break of structure, you see momentum, see displacement. You can be entering, let me take this out. You can be entering at this point, because you are seeing markets running liquidity, and we are seeing displacement, momentum away from the liquidity, telling you that liquidity has been taken already and market wants to reverse. Okay, so you can see here is an example of break of structure plus fair value gap. So you'll be entering on the fair value gap. Then now the institutional order flow plus fair value gap, you can see that price is reacting away from this fair value gap. It's reacting away. So if you miss this move, you can enter here. You can as well also enter here. You can see price react. You can see here again, price finding support in fair value gaps. So as price keeps, so you don't want to be entering here. You can as well enter here, but you don't want, you want to enter as close as possible. So where the move originated from. And then the last, which is the inversion fair value gap. I didn't draw it out here so that it doesn't make the chart clumsy. So you can see this bearish turned bullish for this price. Here was a bearish ICT fair value gap. It became support for price. Let me just clean it out. Now we can see it. So you can see. So it is superposed with the institutional order flow fair value gap. So let me clean it out. There's another one here again. You can see that this is a bearish fair value gap, but price found support again together with the institutional fair value gap. So I hope we can see it clearly. Let me just expand quickly. It will be easy for us to see. So you see this point here. Price found support. So using the three patterns I've just given you, you can see multiple opportunities to enter the market here. Whichever suits you best, which one resonates with you, use that one, practice it, make it your own before you move to the next thing. If you're enjoying this content and you've not subscribed yet, I would like you to do so. And please give this video a thumbs up if this was helpful. If you have any question, I would like to see those questions in the comment section. And as always, I wish you good luck and good trading.